Hello, and thank you for joining Cherry Bekaert's latest technology industry podcast. Today, we are covering important tax planning matters you and your technology company should be or might be considering right about now as we move toward the end of 2023. This will include regulatory areas that can sometimes trip up our finance planners, as well as even our accountants. As well as credit incentive opportunities that we'll touch on that might even be able to benefit your company in 2024 and beyond. Just kind of things to be thinking about again as we move toward the end of the year. So my name is Tim Larson. I'm a tax partner out of Cherry Bekaert's Austin practice, and I'm joined today by my colleague Rob Schwartzman, a tax partner out of our Atlanta office. Rob, I'm glad we have the chance to talk today about tax issues for tech companies as we round out 2023.
Yeah, happy to be here with you too, Tim. I think tax planning is so important this year for early and growth stage technology companies. And I think that's because we find ourselves kind of in a unique place that we haven't been in some time. Generally, when you think about early and growth stage companies, they tend to be focused on a couple things. They're trying to build out their suite of services. They're enhancing and developing their technology. They're building market share, through their go-to-market activities. And as a result of all that, they tend to run, large operating losses that translate into tax losses. The problem we're running into is that we've had a couple what I would call very significant stealth tax increases in the form of disallowed deductions, where now, these operating losses may not necessarily translate into a taxable loss. And as you know, the two primary disallowed deductions that I'm referring to, once again, that have had a very large impact on, early and growth stage technology, are the new rules around research and experimentation costs. They're often referred to as Section 174 costs, and the interest disallowance rules. Interest is no longer just immediately, deductible. There's a series of rules we now have to look at to deduct interest. So if, stepping back a little bit, if you're a technology company and you're heavily invested in R&D, and you're currently investing in R&D, and you rely on leverage or debt financing to fund your activities, and as a result of that, you have a lot of interest expense. Well, these two items alone can push you into taxable income. And I think a lot of companies in 2022 encountered that. But I think the good news is there's some planning around that we can do to help mitigate, the impact of those rule changes.
Yeah, no, I agree, Rob, and sorry to interrupt. With respect to the interest deductibility rules, it's been kind of a creeping. There was a change in back, I guess, beginning in 2018, but this year I think was the first year that now we're seeing in computing the amount that's deductible, the inability to add back depreciation and more importantly for a lot of tech companies, amortization and computing the base for for determining if this business interest expense is deductible. And that's really has had an impact. And same with Section 174. These are provisions that I think a lot of us are still hoping and wishing for some legislation to come in and basically kind of turn off these provisions that possibly retroactively, but most likely in this case probably prospectively. Can't tell you the number of clients that we've worked with this year that might have had even book losses from an operating perspective, but once we work through the tax return because of the needing to add back research and experimentation amortization, particularly if there was a heavy use of foreign contractors, having to capitalize and amortize over whether it's 5 or 15 years, all of a sudden we're in a cash tax position, taxable income position, and having to pay in tax. And it really caught a lot of people off guard, just depending on the amount of experimentation done.
Yeah, it's interesting. The 163J rules, the interest disallowance rules, those are a little trickier to address. It's hard to change kind of the way you're funded, your capital structure. And so, to the extent you can convert some of your debt into equity, that may provide some relief there. But I think with 174, with the research and experimentation costs, I had clients approach those computations kind of in two different ways. Last year, I had several clients that when we take a step back, when we look at 174 costs, these research and experimentation costs, they're not only direct costs, your materials and supplies, your salaries and wages, and your contractor costs, but these 174 costs also include indirect costs. The cost of the benefits of the people doing the R&D and other SG&A costs that are related to the R&D. And I had a lot of clients just say, well, historically, our benefits are roughly 20% or 25% of our direct salaries. And so let's just add that back to our 174 cost. And they took similar approaches for, their rent expense and other indirect items. And then I had other clients who said, no, we want to drill down and see, what are our actual costs associated in the provision of R&E, or in research and experimentation. And they were able to whittle down, their add back, the amount that's capitalized. And for those of you who are not familiar with this rule, prior to 2022, to the extent a company incurred research and development costs, that you could expense them for tax purposes as they were incurred. But starting in 2022, those costs have to be capitalized, and then they're amortized. And that amortization period it depends on where those costs are incurred. So it's 5 years if those costs are incurred in the US. They're amortized over 15 years if they're incurred offshore. So it's really important. And we found a lot of our clients to get that number right. And so this is an area where I would recommend that you spend a little time. And now that this has been out for a year, a lot of people have plowed this ground. I know our firm, we've spent a lot of time thinking about this, and I think this is an area where you can make a significant impact on your tax liability if you spend a little time with it.
I couldn't agree more. And for those where you might companies that end up even in a flow through, if it trickled up to an owner, and there's a tax liability, and you weren't prepared for it. So this is in hindsight. The cost of borrowing now is higher than it has been historically in the past. So, even rates are moving upwards of even 7%. So, these all kind of converged at the same time. And I just also want to note for those technology companies that might be capital intensive, depending on what they're doing. The bonus depreciation, used to be 100% bonus depreciation in 2023. Now it's 80%, moving to 60% next year, which, okay, may not seem so significant, but you're losing the ability to immediately expense some depreciation. And then when you go back to the borrowing costs and the interest deductibility, you're not able to add back. So, there's almost like a double whammy of sorts. So I think it's something that, again, yeah, we're sitting here towards the end of 2023. The year's not over yet, but these are all things that, as we look at and plan for 2024, there still are some things that could be done perhaps before the end of the year.
Totally agree. And it's a lot of it's not very sexy. It's standard blocking and tackling. One of the things that I encourage my clients to do is look at their overall accounting methods. I mean, this is plain Jane stuff, but if you're a cash basis taxpayer, and let's say you have a lot of subscription revenue that's deferred, maybe it's time to move to an accrual basis. Or if you're accrual basis, cash basis accounting can be very powerful. And there are rules out there. They were revised a couple of years ago, but if you meet the test to be cash basis, which is based on gross receipts, if you're a C corporation or partnership, it's a $29 million average gross receipts test over the previous 3 years. But if you meet that, you can elect a cash basis of accounting, and there might be some opportunity there. Not very conventional, but it's might be an opportunity to save some taxes, and it's actually quite easy to do. It just requires the filing of what we call a Form 3115. And along those lines, when we're looking at periods and methods, if you are accrual basis, there are ways to accelerate, prepaids. There's this thing called the 12-month rule that we can apply, and then just other accruals. There's something called the all events test, where if you accrue certain expenses and they're fixed and they're going to pay them within a certain period after your end, you can deduct those in the year of accrual. So those can be very powerful tools that are often overlooked, but it's definitely something worth giving some thought.
Yeah, definitely. As Rob said, plain Jane blocking and tackling. These are, nothing new, nothing proprietary, just kind of going back to the basics. And again, sometimes often overlooked because there's so much information and change out there that it is often easy just to overlook kind of some of the more quote unquote simple ideas and planning techniques to help kind of with cash tax planning, if you will.
Yeah, and then another area that's often overlooked is state and local taxes. And there's a lot of planning opportunities on the state and local side that I think often get overlooked. And the first I would start with is looking at your apportionment methodology. First of all, even taking a step before that, determining whether you have nexus in a state and whether you truly need to file there or not. With the advent of the Wayfair case, we now have economic nexus, and the thresholds are a lot lower. But as a technology company, as a service provider, there are oftentimes different apportion methodologies for service revenue than if you're delivering some type of tangible product. So definitely, I think looking at apportionment is an easy way to maybe reduce your state exposure. And then there are a lot of credits and incentives, both on the federal side and on the state side.
I couldn't agree more. I'll touch on maybe even in the international kind of cross-border context, which can be equally as complicated as the state and local side. Just really kind of looking or reassessing choice of entity, flow through versus non-flow through, offshore. If you're operating offshore, companies might be operating through legal entities, but under U.S. tax rules, you have the option in many cases to elect to treat them different than how they're treated under local law. So you might be able to have a flow through. Mm-hmm. Typically, no different than what Rob said up front. Well, if you're generating losses offshore, you tend to like to have those flow through. But if they're profitable, maybe you don't want them to flow through. So there is a timing to, you can kind of turn off that spigot of income flowing through, but there are some nuances to it. Not to mention there's anti-deferral regimes put in place where maybe you're not onshoring your profits or bringing them back, but you're considered to have deemed dividend or income inclusions due to these anti-deferral regimes, which again, it kind of always makes us revisit even choice of entity within the U.S. You might have a flow through. Is it, while the corporate rates are still at 21%, maybe it makes sense to consider moving into a corporate structure and considering a qualified small business stock exemption potential. So definitely things that can still be looked at before year end, kind of holistically. And, these are the things that we work through with our clients just about every day.
Yeah, and, want to revisit real quick, credits and incentives. If 174 is an issue for your company, by all means, look at the R&D credit and make sure you are claiming that credit. Even if you're in a loss position, it can make sense to claim an R&D credit, especially on the state level. States, I'm in Georgia, and many states do this, but a lot of times you can use that R&D credit to offset payroll taxes if you happen not to be in an income tax position. I know we're talking about estimated tax planning, but there are some benefits to doing, the credits. They offset your tax dollar for dollar. And once again, if you happen not to be in an income position, you can still monetize those credits in a lot of instances against payroll credits. Against payroll taxes. And there's a federal rule around that as well. The other thing I want to say is, within the state realm, a lot of states also have credits for increasing jobs, for retraining employees, and for making investments in the state. And this is basically free money that's waiting for you, and all you really need to do is apply for it. So we would highly recommend that if you find yourself in a taxing situation, or even if you don't, if you're not in a position where you're going to have taxable income, definitely investigate federal and state credits, because once again, it's basically free money, and all you have to do is apply for it. So I think we're coming to the close of this discussion, but just wanted to stress to everyone listening to the podcast that right now, with the tightening we're seeing in the liquidity markets, with a lot of tech companies having stress on their capital structure, the last thing you want to be doing is using your capital to pay taxes. And the message we want to get out is that there are a lot of planning opportunities that exist that can help minimize that liability. And here at Cherry Bekaert, we would be glad to help, if anybody needs any assistance.
I completely agree, Rob. And thank you all for tuning in. And we wish you a tremendous amount of success going into 2024. Thank you, and have a happy holidays.
Thank you.